Some of the most popular money moves in 2026 are quietly costing careful people six figures. Smart investors are skipping them. Not because the advice is evil, because the math changed, and most rules of thumb never got the update. In the next 8 minutes, we run real numbers on 4 famous money moves and show why skipping them can pay. Quick context first. Most defaults in personal finance were designed for safety and simplicity, not for maximizing your outcome. Banks, insurers, and fund companies profit from those defaults. Nobody is paid to optimize your money except you. So the theme today is simple. Run the numbers before you follow the crowd. Let's start with your mortgage. Money move number 1, making extra mortgage payments. It feels responsible, and everyone's parents swear by it. Here's the math. Prepaying a mortgage earns you a guaranteed return equal to your interest rate. Nothing more, nothing less. I sports special resonant percent. If you locked a 3 or 4% rate a few years ago, prepaying earns you 3 or 4%. A diversified stock index has returned around 10% a year over the long run, before inflation. On a low-rate loan, every extra dollar sent to the bank may give up several percent of compounding every single year. Over 25 years, that gap on $500 a month can exceed $200,000. Smart people also protect liquidity. Money inside your walls is hard to reach in an emergency without borrowing it back. The honest exception, rates near 7% or higher, unstable income, or debt that genuinely costs you sleep. And never prepay before capturing your employer retirement match or building an emergency fund. Those come first, always. So the skip is conditional. Low fixed rate, invest the difference. High rate, prepaying is a fair guaranteed win. Money move number 2. Chasing dividend stocks. High yields feel like free income landing in your account every quarter. But a dividend is not free money. When a company pays it, the share price drops by roughly that amount. It's moving cash from one pocket to another, with a possible tax bill attached for the privilege. What actually matters is total return. Price growth plus dividends together. Yield alone tells you almost nothing. Some of the highest yields belong to struggling companies whose falling prices make the percentage look attractive. That's a trap. Chasing yield also concentrates your money in a few old industries. And concentration is risk you aren't paid for. In taxable accounts, forced dividend payouts mean paying tax every year instead of compounding quietly for decades. A broad index fund already holds the dividend payers, plus the growers, at a fraction of the effort. If you love income, you can sell small slices of a total return portfolio on your own schedule. So smart investors skip the yield chase, own the whole market, and judge everything by total return. Money move number 3, whole life insurance as an investment. The pitch sounds magical. Protection plus wealth in one policy. Here's what the actuarial math shows. Cash value inside whole life typically compounds at 2 to 4%. Long-run stock returns are around 10% nominal. That gap, compounded for 30 years, is enormous. In modeled comparisons, buying cheap term insurance and investing the difference ends up tens of thousands ahead. Whole life also starts slow. It can take over a decade of premiums just to break even on cash value. Quit early, and surrender charges can erase years of savings. Many policyholders lapse before the math ever improves. Meanwhile, term insurance buys the same death benefit for a fraction of the premium during the years you need it. The difference in premium. Invested in an index fund does the wealth building without the fees. Fair exceptions exist. Some estate planning cases and people who genuinely need forced discipline. They're a small minority. For most working families, the smart skip is simple. Insure with term, invest the rest, keep them separate. Money move number 4. Hoarding cash and savings. After scary markets, a fat bank balance feels like pure safety. But cash carries a silent cost. Inflation around 3% shrinks its buying power every single year. $10,000 left in a near-zero account loses roughly a quarter of its real value in a decade. Even high-yield savings paying 4 to 5% barely outruns inflation after taxes take their share. Cash feels riskless because the number never falls. The purchasing power falls instead, where you can't see it. The research-backed answer is an emergency fund sized to your job stability, usually 3 to 6 months of expenses. Everything beyond that buffer belongs in assets that historically outgrow inflation. So keep enough cash to sleep well and put the rest to work. Idle money is quietly shrinking money. Notice the pattern across all 4 moves. Each one feels safe, and each quietly trades your compounding for comfort. The fix is the same everywhere. Ignore the slogan, run your own numbers, and respect what compounds over decades. None of this is personal financial advice. It's the math, shown plainly, so your decisions are actually yours. If you want more evidence-based money breakdowns, subscribe to The Long Money. New videos every Tuesday and Friday.